All right, let's make a video update. It's May 15th, 2024. It's about 11 p.m. We've had a big week so far this week. So last week, not much went on. Very quiet week data-wise, so I didn't make a video update. There was really nothing more to add to what I had written in the newsletter. This week is different. We have a lot going on. So just to take a step back, coming into the week, my belief was that the inflation reports would come in relatively favorably, benign, and that the market would potentially make new highs. And that's pretty much exactly what happened. Why did I think that the inflation reports would come in favorably? Well, that's basically how the smart money was positioned. So coming into this week, the smart money was bullish on equities. They were bearish on the dollar. They were solidly bearish on the dollar. They were solidly bullish on equities, and they've been selling gold. So the fact that they've been selling gold, to me, implies that they might see a benign macro environment on the horizon. And a benign macro environment would almost certainly require that inflation is going lower. And because if inflation is going lower, bonds are likely to do well, equities are likely to do well. So why would someone need to hold gold, which doesn't have any yield to it? It has storage costs, whereas equities have dividends and bonds have coupons. So if those are doing well, there's really no need to hold gold, and the smart money has been selling gold. So to me, that implies that we could have the perception of a benign macro environment where the narrative shifts to potentially a soft landing again. And so that was sort of my belief coming into this week, that equities would potentially make new highs if inflation came in cooler than expected. And for the most part, so the PPI yesterday did not come in cooler than expected, but apparently they revised last month's value a lot lower. So the fact that it was high for this month was diminished a little bit because they had lowered last month's. Whereas with the CPI, the headline number did come in cooler than expected, and the core came in roughly in line, maybe slightly cooler, at the decimal point. But the market liked it. We had a big rally in equities. The S&P was up over 1%. The NASDAQ was up 1.5%. Russell 2000 was up, 1.2%. And the S&P made new highs. SPY, the S&P 500 ETF, its March high was 524.61. Today it closed at nearly 530, so it's more than 1% above its March all-time high. So let's look at these macro assets, and we'll get to equities again later in this discussion. But here we have the dollar. So as I mentioned, the smart money has been bearish the dollar. They turned bearish in February. The dollar immediately fell, but then it started to rise because the economic reports were coming in strong. Inflation was coming in hot, and it went up pretty solidly. And as it was going up in, late March and into April, equities started facing some headwinds. Oil was rising at the time. Inflation was looking, not so great. And there was some speculation that the Fed might have to repivot and become more hawkish. But the Fed did not become more hawkish. In fact, at the press conference in the last FOMC meeting, Powell said that the Fed basically had two choices: one, hold rates steady, or lower them. He didn't list raising rates as an option, so the market took that as dovish. Yesterday, he was at some Q&A session where someone asked him pretty much the same question, and again, he said that he doesn't see the Fed raising rates again. He said it would take a very high bar to clear for him to get on board with raising rates again. So again, basically the Fed has this bias towards cutting rates, or at worst holding rates steady, and it seems like they want to cut rates. And from a bigger picture perspective, the U.S. fiscal situation with all the bond supply coming online, it really needs a weaker dollar and loose financial conditions so that bond market volatility is, pretty relaxed, and they can sell those bonds without causing dislocations in the market. And if the bond market is relaxed about that, then equities are likely to do well, and they need equities to do well because they need tax receipts to lower the deficit so they can reduce the supply of treasuries. So the U.S. fiscal situation is pretty fragile. They need a weaker dollar. Big picture, the smart money knows that, and they're betting on a weaker dollar. And so far, we're seeing that. As you can see here, the dollar is now back below where the smart money turned bearish. Financial conditions are quite easy. Here we have the financial conditions are basically back to where they were in 2021 when the meme stocks were going crazy. And you might have heard that AMC and GME, GameStop, and AMC was at American Movie Cinemas or something. I'm not even sure. But they're going crazy right now as well. So financial conditions are loose. Here's an interesting tweet from Jason Gopford. Financial conditions are at a new low for this cycle. As long as they're below the 8-week average, stocks have a major tailwind. So we have a situation where, stocks will probably fluctuate. They've been up 10 days in a row. They might pull back from here, but basically, oil's come down, interest rates have come down, financial conditions are loose, smart money's bullish on equities. It's an election year, deficit spending isn't slowing down, so equities have a lot of reasons why they're likely to move higher. But again, we'll get to equities later. So here's dollar relative sentiment. It's below zero. It's more than one standard deviation below zero. It's pretty strongly bearish. I've mapped this black line into a percentage so that I can plot it alongside the dollar returns. As you can see, when it was greater than 50%, meaning it was bullish, the dollar appreciated, and then it turned bearish and the dollar fell, but then it kind of rose at the latter part of when it was bearish there. It turned bullish and it was slightly down, then it turned bearish, and now it's back below where it turned bearish. This data isn't updated through today. So dollar relative sentiment tends to have a good bead on which direction the dollar is going to move. Again, we'll see how the smart money has repositioned after this week. We'll see that on Friday, but as of now, it probably takes several weeks of strong buying by the smart money to turn dollar relative sentiment bullish. So we can expect it to be bearish for the next several weeks. And, given the tendency of the dollar to weaken when dollar relative sentiment is bearish, we should then expect the dollar to drift lower as well. So here's gold. We'll move on to gold. So gold is back, flirting with the 2,400 level. I guess the bottom line, the takeaway for precious metals, in my opinion, is that if you're not already long them, then it might not be the best time to get long them right now. They may have a few more weeks of rally left, or they may have already topped. But what's happening under the hood in the precious metals market isn't very bullish. So here we have gold. It's way above its 200-day moving average, which unfortunately is not on this plot. I'll do that next time. But it's roughly around where this circle is, and we have this trend line here. So it wouldn't be surprising if gold eventually comes down here to test this level, which would be right around where it broke out. And if gold relative sentiment turns bearish, which it looks like it will do unless institutions start buying aggressively again, which I don't think they will, then we could see gold pull back while equities and bonds potentially rise in a benign macro environment, or at least one that's perceived as benign, but it might not actually be benign in reality. So here is composite gold relative sentiment. It's a composite of gold and silver relative sentiment and dollar euro relative sentiment. And when it's above 50%, it's bullish. When it's below 50%, it's bearish. Right now, so this is a smooth time series of an underlying time series that looks at the spot relative positioning. So this smooths the spot relative positioning over several weeks because the spot, fluctuates a lot, but if you smooth it out, it becomes a pretty powerful directional signal. I'll have to plot the spot relative sentiment next time because currently the spot is below 50%. So this blue line will start drifting lower and turn bearish if the spot relative sentiment doesn't pick up in the next few weeks. I project that it will turn bearish either the first or second week of June if institutions don't start buying gold on a relative basis again, gold or silver. And they're pretty bearish on both of them right now as far as their spot positioning is. So I don't think they'll have enough time to turn it bullish again, but we'll see. So if we work under the assumption that gold composite relative sentiment is going to be turning bearish in a few weeks, and that might mean that we only have a few more weeks of conditions that are favorable for gold, that are a tailwind for gold. That said, gold could potentially have already topped. We might be retesting the 2400 level before rolling over. We'll have to see how that plays out. But I would be quite cautious about buying gold here if you're not already long. So, keep that in mind. Same thing with silver. Silver has the same underlying relative sentiment relationships that gold has. And again, it too will have negative composite relative sentiment in a few weeks' time. So again, silver could be, a little bit precarious if you're thinking of buying it here. So here's silver. It's a 4-hour chart. It made it all the way back up to the $30 level. That's probably going to be some interesting resistance. Now, when it first made it up there several weeks ago, this was April 12th, I believe it made it here, it got slammed down quickly. So it got up to 29.92, I think, and then boom, it just fell like a stone. And you could see, boom, it had this big red candle, and then it fell even more down into the 26s, and it came near to this level where it had broken out, and it fell, below this up channel between these two lines here. But now it's risen again back up to that 30 level. It's now outside this channel, these two blue lines. It's outside that, so that's a little bit scary. And it's at this $30 resistance level, which is also a little bit scary. However, the fact that we've gotten beat down there multiple times in the past, and when we were there, it got beaten down pretty quickly. It's been hanging out around $30 now for several hours, and it hasn't gotten beaten down yet. Now, when I took this snapshot, silver was slightly over 30. It's 11:10 p.m. and it's 29.82, so it's fallen, 17 cents, but it seems fairly stable. So we'll see if it can push through there tomorrow. If it can, maybe there's some significant upside to be had. But then I would look for it to pull back and test that $30 level from above sometime in the next several days or weeks. And, if and when, silver and gold relative sentiment, the composite relationships turn bearish, who knows where silver can potentially fall to. And we'll have to see how that all evolves. But again, if you're not long silver already, it might be a little bit late in the game. Here's a weekly chart of silver. You can see it's at this level where it got beaten down pretty badly before. This is the fourth time. It might be the charm. We'll see. Here are miners. Miners have been up 40% in the last 2.5, 3 months. They're at resistance as well, but they also have this gap here, which is not too far above where they currently are, 2 or 3%. Maybe they close that gap. But then after that would probably be close to a 44% rally from the recent low down here in I think February. So 44% rally in a few months. I would probably then expect it to, at best, chill out and move sideways, or potentially at worst pull back, especially if the gold and silver composite relative sentiment turn bearish, which it looks like it will. So here is that same composite relative sentiment relationship that I showed for silver and for gold. This blue line is the same for all of them. Here's how miners have performed, based on this. So it was wrong here, and it was wrong here. It was kind of flattish here, but otherwise that green worked out, that green worked out, that green worked out. Most of these reds worked out. So it's generally been a pretty good predictor of miner movement, which is saying a lot because miners are, really went nowhere. And this actually has led to positive returns if you're long when it's green, and positive returns if you're short when it's red over the long term. So again, if this thing turns red, if this blue line goes below 50%, which it looks like it will, it could be a little bit dicey for miners, especially after the large rally that they had. However, long term, I still love gold. I still love silver. I love miners. I think miners and silver will probably outperform gold. The gold to miners ratio was pretty extreme, so likely miners are going to outperform gold, and I expect gold to do well, so miners are likely to do exceptionally well over the longer term. But this is purely, tactically speaking, over the near term, miners could be reaching the end of their current rally. Here we have TLT. I think either in my last video or in one of the recent weekly newsletters, I had mentioned that I thought bonds could potentially have a tactical rally. Now I'm very negative on bonds long term. I think inflation really isn't going away. We might have a little respite here where it appears to come down and the CPI looks good, and how they calculate it, the mechanics of that. But I think that just with all the bond supply and deficits and the U.S. fiscal situation, you're not really going to get a real return from bonds with where interest rates are currently, most likely. So I'm generally negative on bonds. However, I thought we could potentially have a tactical rally in bond. And one of the reasons I thought that was because the relative sentiment relationships for bonds, they were bullish starting sometime, I think, in April, and TLT kept going down. But then a second wave of relationships that are generally predictive of TLT turned bullish on May 3rd, which is right here. And, they've been up since then. Ultimately, they generally need interest rates lower, just so that there's, no dysfunction in the bond market. And so equities have a tailwind. So, this is almost a political thing as opposed to, or in addition to a, positioning thing. The people that are positioning the smart money probably knows that they want interest rates lower and are positioning accordingly. So here's that composite relative sentiment relationship for TLT. In the last couple of years, it's actually been quite solid. I just looked at this recently. So when it was red, it went down, green went up, red went down, green went up, red went down, green went up, red sideways, green went down, but now it's starting to turn back up, and it started to turn back up slightly before the second wave of relative sentiment relationships came in and turned bullish for TLT. We'll see if that can continue. I think that it has the potential to do so. The, financial conditions we showed earlier are, quite loose. This is the bond implied volatility chart. Has moved lower. It's one of the lower levels in the last year or so. So that's positive for interest rates. The 30-year was at, I think, 470 something last Thursday. Now it's at 448. So it's come down over 20 basis points since last Thursday, which is a pretty big move. So we'll see, if that tactical rally in bonds can continue. Here's oil. So oil was actually played, I think, a fairly big role in equities rallying and bonds rallying. In mid-March, we had tensions in the Middle East, Iran and Israel. Oil was at $88. When that situation de-escalated, and the White House continues to try to de-escalate what's happening in Gaza, oil's fallen 10%. Looks like it might be stabilizing here, so maybe we get a bounce, but as it's fallen 10%, retail commodity sentiment has come down. You have less inflationary headwinds, and equities have responded accordingly. They've rallied, back to all-time highs. They've surpassed the March high from the April 19th low. The S&P's been up 10 days in a row. So I think a lot of that is attributable to oil coming down, and it is an election year. Obviously, they don't want oil to rally strongly and gasoline prices to rise going into the election. So we might, oil might stabilize and hang out here. If it starts to rally again, that could put some pressure on equities again, and that wouldn't be good for equities. But we'll see what happens. Longer term, oil is likely to rise just because of the secular environment we're in. And you can see we're in what looks to be a long-term cup and handle pattern. So we are, potentially in an area where it might stabilize and start drifting higher. But I'm sure the White House will try to do everything it can to keep it from drifting too high. XLE, here's an interesting situation. So it was in this ascending triangle. It broke out. But then oil started to fall and it pulled back. from about 98, 99 down to, I think, 92, 91 the other day. But now it's still hanging out right around that breakout level at 93.66, I think it is. It's imprecise, but it's in between 93.50 and 94. Now, if oil goes lower, XLE might go lower. If it doesn't go lower, but oil does go lower, that would actually be quite a good sign that XLE is pretty resilient, pretty strong, and likely has a bright future. If it does fall, if oil continues to fall, then this trend line might be in an area where it might make sense to get long again, but we'll have to see how that evolves with oil. Here is the U.S. equity market. This is the S&P 500 futures. So it fell, and then it looked like it was in a bear flag, and a measured move would have brought us back down to the previous all-time high in the futures from January of 2022. But that was entirely short-circuited, it looks like, and the market just continued to rally. It rode this trend line a little bit, and then we had the PPI yesterday, and it rallied. We had the CPI today, it rallied big. It's up a little bit after hours. Now, it's been up 10 days in a row, so it wouldn't be shocking if it pulls back a little bit from here. Also, Friday is option expiration, so we might get some shenanigans with flows and hedging and this, that, and the other that kind of pins it, where it currently is, or maybe a little lower. I wouldn't expect another big move for the rest of the week. I would expect it would probably hang out in a range. But as we've discussed previously, financial conditions are loose, oil's come down, smart money's bullish, they're bearish the dollar. A lot of things are working in equities' favor. Inflationary headwinds have come back. The CPI allows the market to price in another Fed rate cut. The Fed has told us that they're not going to raise rates, and it's an election year, and they're not going to stop deficit spending. So you have all these things kind of putting upward pressure on equities. So even if it does pull back, I would expect it to turn around and rally again. We'll look at some things related to that. So here is composite equity relative sentiment. It's at 61, which is a decently bullish level. Anything above 50 is bullish. It caught the turn here when oil prices were high, and positioning actually turned bearish, as well as the retail commodity sentiment. But it turned on a dime at the low on April 19th and got bullish again, and it's ridden it up from there. So this doesn't include this week's rally, so it's now above 113% since January of 2022. We are currently in the 60 to 80% bucket. That's the thick green line here. The market tends to spend most of its time in that bucket out of all the other 4 buckets, and it tends to do quite well in that bucket. Since 1994, it's annualized 20%. When composite equity relative sentiment is between 60 and 80, its volatility is 15%. Its maximum drawdown in that bucket is 15 Sharpe ratio of 1.3. It spends most of its time there, that's about 60% of the time. No, actually, no, that's not 60% of the time, but it's probably 30 or 40% of the time, which for a 20% bucket, it's kind of overrepresented in that bucket. If we look from 2018 to the present, it annualized 27% when it's been between 60 and 80, again with a 15% drawdown over that time period, maximum drawdown. If you look at the performance since, again, this green line is the 60 to 80 bucket, it spent most of its time there and it's done fairly well there. So we can, it's essentially the positioning environment, the composite equity relative sentiment environment is fairly favorable for equities here, and not as favorable as the 80 to 100% bucket, which, as you can see, has a Sharpe ratio of 2 with an annualized return of 37% since 2018. And I think it has a Sharpe of 3 with an annualized return of 47% since 1994. So it's not quite as good as being above 80% on composite equity relative sentiment, but it's pretty good nonetheless. We also are in a situation where momentum is positive and composite equity relative sentiment is bullish. That puts us in quad 2 since 1994. Equities have annualized 17% when momentum is positive and composite equity relative sentiment is bullish. Since 2018, they've annualized 24%. in this quadrant. So again, you have, favorable momentum, favorable relative sentiment. So we essentially have a somewhat benign backdrop for equities, and I would expect equities to drift higher. I don't think today marks the ultimate top. I think we'll likely have continued rally over the next several weeks or months into at least the summer. That's my baseline expectation. However, because valuations are already at bubble levels, I would then expect us to potentially put in a major market top sometime later this year that we might not see again for many years. So if we look at our preferred valuation metrics, so this is as of last Friday, it was expecting an annualized return of only 0.9% over the next decade for U.S. equities. Given this week's rally, that 0.9% is probably going to fall to 0.7, 0.6, depending on what happens tomorrow, Friday. If we pull back, it might stay at 0.9, but if the market holds its rally so far this week, that will fall to 0.7, I would imagine, given how much it's rallied so far. If we look at the underlying valuation ratio, this was again as of last Friday, 0.501. Almost certainly that's higher this week. So, and that's just shy of the everything bubble level where the market fell 25%. It's just shy of the .com bubble level where the market fell 50%. Now, to get from 0.5 to 0.527, that would probably require that the U.S. equity market, the S&P 500, goes from about 5350 where it's at now to about 6,000. So that's another 10% rally, roughly 10, 11, 12% from here. That would take us back to these .com bubble levels, but hey, it might not stop there. It might, become the all-time biggest bubble that we've seen. And, if it goes above 6,000, that would likely be the case. If you look at the expected equity risk premium, this again was as of last Friday. It was at minus 3.6%. Now, bond yields have come down, so that's favorable for this equity risk premium. However, equities have rallied, so that will lower the expected return. So this 3.6% might not change much. It might be 3.5, 3.7 when we calculated this Friday. But nonetheless, we haven't seen an expected equity risk premium this low since the run-up and aftermath of the .com bubble. If the S&P runs up to 6,000, this will probably drop closer to -4, -5%. And secular bull markets don't start when bonds are going to outperform equities by, hundreds of basis points over the next decade. So we're, I think, much closer to the end of this cyclical bull market. And I think we are already in a secular bear market where equities won't outperform inflation over the duration of that cycle. And as you can see from, let's see where it is. I think it's right here. Prior to today, equities were up 13% from the top in January 2022, and inflation's up roughly the same. So equities over the last 2 years haven't outperformed inflation, which is the definition of a secular bear market in equities. All right, so I like to show this chart because I think this is something that will manifest in the markets. This is the ratio of the NASDAQ to the Russell 2000, the NASDAQ 100 to the Russell 2000. Tech is a crowded trade. Small caps are not a crowded trade. If we continue to rally in equities, I would expect small caps to outperform. Probably doesn't make sense from a fundamental perspective. I don't know if any of those companies have positive earnings or if the index has positive earnings. But, when is the market about fundamentals? It's only about fundamentals in very rare instances, and then they matter. But for the most part, they don't matter. This ratio, so it's been in this channel. If you can, look, this is a daily chart, but if you look at a weekly chart, this channel goes back 6-7 years, and it can find that ratio. It recently hit the top of the channel, came down, again came close to the top. It's been going sideways for the last 4 or 5 months, but as it was rallying and going sideways, the momentum, it just keeps going lower and lower. So I would expect the Russell 2000 to outperform the NASDAQ from here, given how crowded tech is and how small caps aren't crowded. And I would expect this to drift towards the lower end of the channel as we move, further into this year. Now it's started to rally the last, week or so. This is a daily chart, so that's, roughly 2 weeks. It's been drifting higher. Today, interestingly, when the CPI came out, the Russell 2000 immediately started to outperform the NASDAQ. And, right at the peak of the Russell's rally this morning, it was 90 basis points ahead of the NASDAQ on the day. But it finished the day 35 basis points below the NASDAQ. So it basically intraday, the NASDAQ outperformed by, 120, 130 basis points. So a big reversal in that ratio today, but I think over the longer term, next several months, I would expect this to start drifting lower if equities continue to rise, because for equities to rise, we likely need inflation to come down, interest rates to come down. Russell's probably a little bit more sensitive to interest rates now than the NASDAQ is. And so I think that would play into the Russell's outperformance, potential outperformance. I think that's going to happen. We'll see if it actually does. Here's NVIDIA. So the question I had was this thing here the left shoulder, and then this was the head, and then we're going to do a right shoulder and down, or was this the left shoulder? It's starting to look like this is one big left shoulder, and that this might have a lot higher to go to form a head, and then come back down and form the right shoulder, and then that's it for the bull market. NVIDIA has earnings on Wednesday next week. I really have no insight into, what they're going to say, but my hunch, my instinct, and my suspicion is that, it's still probably pretty early in the, spending cycle for these artificial intelligence, training these models, and you need the chips, and you need the NVIDIA hardware. So NVIDIA might still be benefiting greatly from that. They might put up, some bonanza number, and we might get a huge bounce in NVIDIA next week, which would likely take the market as a whole higher as well. Here we have Meta. I love this chart. This megaphone is pretty perfect. It, could find it up here, and then they had earnings, which they said they were going to spend a ton of money on artificial intelligence. The market didn't like that. It fell. It didn't quite close the gap from when it, jumped here at its prior earnings in January. So, and it looks like it might go up here and close the gap from when it fell a few weeks ago. But ultimately, I would expect this to move toward the lower end of the channel when the bull market, tops. But until then, we might see it again push towards the top end of this megaphone, maybe ride that megaphone until the market as a whole tops. And then I would expect this thing to just start drifting lower. This was a 6.5 time move from 80 to 520 in 15 months. I mean, it's pretty absurd. Here we have Apple. I don't know if anyone recalls from a few weeks ago, we had in one of our videos, it was right before Apple earnings, so it was 2 or 3 weeks ago. We said that we didn't know what Apple earnings would be, but the fact that it couldn't really go much below 170 and it was kind of hanging out there, even though you had all this relentless bad news about about Apple and how their China sales were down by, double digits, and things just didn't look good from a fundamental perspective, yet it just couldn't sell off. That to me suggested that smart money was buying Apple. And then they came out with earnings. And again, I don't necessarily think the earnings were all that great, but they did announce I think $100 billion stock buyback, and it's jumped from 170 to 190. So a 10% move in a couple weeks since those earnings. My suspicion that I mentioned prior was that Apple might be the leader in the next leg higher for the market, and it looks like that actually might be playing out. If this pattern plays out, a measured move would take it to around 250. So it's at 190, so, potentially another 60 points from here, which is, close to a 30% return. we'll see if that actually plays out. But if the market still has room to rise into, ridiculous bubble level territory in an election year with inflation coming down and a Fed eager to cut, then we might get sort of a blow off top in equities, and then maybe we do see Apple pushing 250. But, we'll see how that plays out. Well, that is all I have for today. That was an exceptionally long video, 37 minutes. Usually they're, less than 30. If you're watching, thanks for watching. If you have any questions, feel free to hit me up in the comment section. And, until next time.